Let us start today's video. Today we will talk about the journal entries. Let us start with the transaction number 1. In this video we will show you the effect of journal entries on the journal and later we will post in the ledger. In the first entry, Abbas introduced rupees 30,000 cash as capital. So if the first entry we say is that Abbas is bringing a cash, and we write here is that Abbas is bringing cash within the business in the form of his share. So cash, which is an asset account, is debited with amount 30,000 rupees. And as a double entry concept, the account will also be will be capital account, and capital account gets credited with the amount of 30,000 rupees. So here the first entry is complete, in which there is a cash account. Cash is a debit because the cash is increasing, and capital account, which is the share of the owner that he is bringing in the business, is increasing, which will be credited. In my second entry, Abbas borrows rupees 40,000 to purchase a van. So here we going to van account. Van is an asset. Asset is increasing. He's going to purchase a van, and he's going to pay a liability as liability is increasing, so it will be credited with an amount 40,000 rupees. So van, which is an asset that he is going to purchase, and the van is going to be purchased using a liability for which he is not going to pay right now. He has to pay it in future, so which is a liability, and whenever there is increase in liability, it will always be credited. And the van is an asset account which is debited, because whenever there is increase in asset, it will be debited. So according to my third entry, Abbas buys a market stall for rupees 5,000 cash. So he's going to buy a stall or a market stall on which he can put his products as a showpiece or something. So he's going to buy a market stall. So market stall is an asset, as he's going to earn long-term benefit from market stall, and he's going to pay using cash. So market stall is an asset, and asset is increasing with an amount 5,000 rupees. On the other hand, cash is a asset which is decreasing with an amount 5,000 rupees. So let us start the fourth transaction of today's lecture. According to the fourth transaction, Abbas buys inventory of 18,000 on credit. He is going to purchase an inventory on credit, means that he is not going to pay right now. He will have to pay in future. So inventory is an asset. Inventory account, which is an asset, and it is increasing with an amount 18,000 rupees to payable. So we mention here that is payable for inventory with an amount 18,000 rupees. Again, payables are the liabilities, so whenever there is increase in liability, it will be credited. According to my fifth transaction, Abbas pays his supplier rupees 10,000. From his supplier he purchased inventory, and he has to pay in return of 18,000, but now he's paying 10,000 rupees. So we write here inventory payable, which is liability, which was the liability of 18,000, but now he's going to pay 10,000. So whenever there is a decrease in liability, it will be debited, and he is going to pay through cash account with an amount 10,000 rupees. So cash is reducing, which is an asset, and it will be credited. Here we'll talk about our transaction number 6. So according to the transaction number 6, Abbas sells inventory of 12,000 cash. So he is receiving a cash account rupees 12,000, as he's selling inventory, and sale is a revenue account which is increasing, which will always be credited. On number 7, if we talk about Abbas sells inventory of 9,000 on credit. He's again selling but on credit. So inventory debtor we can say, or we can say debtor if the name, if you have only one debtor, then we can say debtor account of rupees 10,000, sorry 9,000, to sale account, and sale is of 9,000 rupees. According to 8 number transaction, Abbas repays rupees 10,000 of loan. Here he took a loan of amount 40,000. He took a loan against a van of 40,000 rupees. In my 8th transaction, Abbas is going to repay the loan of the van. So here we says van payable, which was liability, to cash account. When payable were 40,000, but now he's currently paying 10,000 rupees. So cash is an asset, cash is decreasing. Whenever there is a decrease in asset, it will be credited, and the when payable is a liability which is decreasing also, so it will be debited. In my 9th transaction, I will show you Abbas pays his trade supplier for rupees 6,000. So he took inventory of 18,000, and now he is going to pay. Previously he has paid about 10,000 rupees to his supplier, and now he is going to pay 6,000 more to his trade supplier. So we write here it is inventory payable, which was again a liability, to cash account. Inventory payable was liability, and whenever there is a decrease in liability, it will always be debited, and whenever there is a decrease in asset in the form of cash, it is always credited. So in my last and the 10th transaction, Abbas received rupees 8,000 of the money owed to him by the customer. Basically he sell his goods on credit, so he sold goods of 9,000 rupees, so he received 9,000, and 1,000 will remain be in the debtor account. So here we write cash account, as he has received cash account, to debtor account. Cash is increasing with an amount 8,000 rupees, and the debtor, which is an asset, is also decreasing, and when the debtor is decreasing, when an asset is decreasing, it will be credited. This was basically the effect of journal entries. Now we will show you the effect of these journal entries in the journal ledger. Basically we post all these entries within the journal ledger. If you like my video, kindly subscribe to my channel and press the bell icon for more upcoming videos. Thanks for watching my video. Have a good day.